Welcome to Breaking News to Trading Moves. Today we are focused on a stack of information detailing Walmart's recent Q3 earnings report and what those results really suggest about the spending habits of the real U.S. consumer. For you, the listener, this analysis is a shortcut to understanding retail dynamics right now.
That's right. Our mission is to really analyze the context from this one retail giant and identify which parts of the market stand to gain and, which parts are facing pressure.
Because of Walmart's scale, its results are like a direct window into the budget realities for millions of American households. So we're going straight to the core questions the market is asking.
Exactly. The first one is all about consumer priorities. Can strength in grocery and essentials continue to drive overall growth? I mean, this is the bedrock of stability for so many retailers.
And then there's the operational side. How efficiently or even how profitably is e-commerce operating for Walmart? Digital sales are a must, but they often come with these burdensome costs.
Right. Logistics, fulfillment, returns. And finally, the big one. What does Walmart's forward outlook say about the purchasing power of lower and middle-income shoppers, especially as we head into the holidays?
That guidance is the real barometer, isn't it?
It dictates trading patterns across the whole landscape.
Let's jump right in. Because understanding this mood of consumer caution, it defines everything that follows. So when we say this report is a proxy for the cautious consumer, we're talking about more than just, flat sales. It's a read on psychology, on the trade-offs people are making.
Right, and we should focus on those three areas we just mentioned. Let's start with grocery and essentials. This category is so important because it really represents the bedrock of economic resilience.
People have to buy food.
Exactly. You might delay buying a new TV or a new jacket, but you can't stop buying toothpaste or milk. For Walmart, the market is watching whether their comparable sales growth is, overwhelmingly driven by this category.
And comparable sales, just to remind everyone, that sales at stores open for at least a year.
Correct. So if the growth is all coming from groceries, it just confirms that consumers are prioritizing necessity over desire. It validates Walmart's whole strategy of using low-priced food as the ultimate traffic driver.
Get them in the door for eggs and hope they buy a T-shirt while they're there.
That's the model.
Yeah.
But the core story is that consistent demand for staples.
It feels like this narrative, this shift to necessities, has been the story for a few quarters now. Is there any indication that's changing?
Actually, it's quite the opposite. The analysis suggests that high costs in other areas, think housing, car insurance, they just continue to eat away at discretionary savings.
So people have no choice but to be disciplined.
Right. So if Walmart reports continued strength in grocery, it just confirms this defensive behavior is persisting. It tells us that consumers are still allocating the biggest chunk of their spending to just basic human needs.
Okay, that makes the second point. E-commerce profitability even more critical. If people are relying on Walmart for staples, they're increasingly using the app for pickup or delivery. How does Walmart make that profitable with all the costs of last-mile delivery?
That is the trillion-dollar question for all of modern retail. In Walmart's operation, it gives us some crucial insights. I mean, growth is expected, sure, but it's the efficiency of that growth that matters.
And they have an advantage with their physical footprint.
A huge advantage. They use their stores as fulfillment centers. This store-as-fulfillment model lets them bypass the really expensive centralized warehouse model that pure-play e-commerce companies have to rely on.
So when I order groceries for pickup, someone is just walking the aisles of my local store and grabbing them off the shelf.
Often, yes. And that drastically reduces the distance the item has to travel, which saves time, labor, and most importantly, fuel costs. The analysis really highlights that success here is what turns high digital volume into profitable digital growth.
It stops the margins from getting eroded by all those extra costs.
Exactly. So if Walmart can report growing digital sales and stable or even improved margins, that's a huge victory. It's a signal that the hybrid brick-and-mortar and digital approach can really work.
It means they figured out a cost-effective way to deliver convenience.
Right. And any commentary from them on automation in stores or how they're managing last-mile logistics, that provides valuable context for every other major retailer wrestling with this exact same problem.
And that brings us to the most sensitive indicator, the lower and middle income outlook. Walmart's guidance here has so much weight because of who their core customer is.
This is where the retail analysis connects directly to the broader economic health of the country. Walmart's guidance gives us insight into how the paycheck-to-paycheck shopper is navigating things.
And it's not just how much they're spending, but what they're buying.
Precisely. For example, if Walmart points to a big jump in demand for their private label goods, their great value brand, that's a clear signal that budgets are under extreme pressure.
People are actively trading down from national brands to save a few dollars.
A few dollars per item, which adds up dramatically over a whole shopping trip.
I'm curious, does the analysis say anything about shopping frequency? Are people making fewer, bigger trips or more frequent, smaller ones?
It seems like consumers are being incredibly strategic. So yes, you see consolidation, bulk buying, which we'll get to, but among those with the tightest budgets, there's also evidence of shopping closer to the paycheck cycle. They're managing cash flow week to week.
That makes sense.
So Walmart's forward-looking statements about inventory and staffing for the holidays, that gives us a direct gauge of expected purchasing power. A cautious outlook there suggests holiday budgets will be very tightly controlled.
So the overall theme is rational behavior driven by economic pressure, prioritizing staples, demanding digital convenience but at low prices, and managing spending. This really sets the stage for the winners and losers. Okay, let's look at the segments that could see some positive momentum from a strong Walmart Q3. This is all rooted in that consumer pivot to value. We have three key groups of winners here.
Right. And the first one is the most straightforward, value-focused big box retail.
Of course.
If Walmart, that's WMT, reports robust traffic and solid comparable sales, especially in groceries, it just validates the whole thesis that shoppers are actively trading down. They are consciously choosing lower-cost places for their core needs.
And when we say trading down, what does that actually look like in practice?
It means a family that maybe used to shop at a pricier regional grocer or was spending more on eating out is now shifting those dollars to a retailer like Walmart. They're consolidating where they know the price per item is just consistently the lowest.
So Walmart itself, WMT, is the direct beneficiary. A strong report proves their model is working.
It absolutely validates their massive investment in both price and logistics. Their strategy is working, but it also has an effect on others.
Right, the analysis points to Target, ticker TGT, also benefiting. This is where I want to pause for a second. Target often has a higher mix of discretionary stuff like apparel and home goods, which seem to be lagging. So if Walmart's strength is purely in essentials, why would a positive report help Target?
That's a great question, and it's not just, general market optimism. The connection is based on shared operational improvements. Target has also invested heavily in its essentials category, which is now a huge portion of their sales.
Okay.
And while they do have that higher discretionary mix, they've also gotten much, much better at same-day fulfillment, grocery pickup, and integrating their digital channels.
So if Walmart is proving that store fulfillment can be profitable, investors assume Target is also capturing that same value-driven, convenience-seeking customer.
Exactly. And both WMT and TGT are attracting that same middle-income consumer who might be trading down from a department store. A positive result for WMT just signals that the whole big box strategy is working in this environment, which supports TGT as well. It's a validation of the multi-category value model.
Got it. So it affirms the entire scaled omni-channel value strategy. Let's move to the second group of winners, club and grocery-heavy retailers. This seems like a perfect fit for a consumer focused on efficiency.
It is. This matters because it confirms the consumer's need to lock in long-term value through bulk buying. The entire thesis for companies like Costco, COST, and BJ's Wholesale Club, BJ, is that resilient demand for essentials combined with the search for savings.
When your budget is strained, that membership fee starts to look more like an investment.
It's an investment that guarantees lower unit costs on things you buy all the time: paper towels, packaged goods. If Walmart confirms consumers are prioritizing staples, it directly validates the economics of the whole warehouse club model.
And Walmart has its own club division, Sam's Club, so they have a direct read on this.
Precisely. Any strong commentary from Walmart leadership about performance or membership growth at Sam's Club serves as a really positive signal for the entire industry. It suggests cautious consumers are actively seeking out bulk options.
Which is a direct positive for a company like Costco.
Oh, massively. COST thrives when food inflation is persistent and consumers are budget conscious. Strength in the overall grocery environment just confirms their ability to maintain high traffic and robust sales.
And this would apply down the line to others in the space.
Yes, the same tailwind applies directly to BJ's Wholesale Club, BJ. If the trend is toward buying necessities in bulk, BJ sees a similar pattern. Members just allocate more of their wallet to the club. It reduces uncertainty about the resilience of their model.
Okay, so our third group of winners gets into the supply side. The big consumer staples brands with pricing power. These are the brands on the shelves. How does Walmart's commentary affect giants like Procter & Gamble or PepsiCo?
Well, this relationship is always defined by a bit of tension. Walmart is their biggest buyer, so PG, PEP, and others rely on them. The health of these suppliers really depends on what Walmart says about the promotional environment.
Let's define rational promotional environment. What does that actually mean?
It means that both the retailer and the supplier are being disciplined. They're avoiding panic discounts or, unnecessary price wars. If Walmart reports that volumes are steady in essential categories and they aren't having to slash prices on brands to move product, it means two things.
Okay.
First, the consumer is still willing to pay a little more for the brand name, which shows loyalty. And second, crucially, it signals that PG and PEP are holding their shelf space and maintaining healthy margins.
They have true pricing power. They can pass on their own cost increases without losing too many customers to generic brands.
That's the metric the market is watching, and Walmart's results give us a real-time test of that balance.
Let's look at Procter & Gamble, ticker PG.
PG is a prime example. Their portfolio is full of essential household and personal care items. If Walmart's commentary suggests that branded products are maintaining their volume, that people are sticking with Tide, Pampers, Crest, it reassures investors that PG's margin structure is intact. It suggests PG is holding the line against Walmart's own private label brands.
And what about PepsiCo, PEP? It's a similar but slightly different space.
Right. PepsiCo benefits if management commentary indicates sustained demand for essential food and beverages without margin erosion. Think Frito-Lay or Quaker Oats. These are small, affordable indulgences or staples people still prioritize.
Sure.
If Walmart confirms these are moving well at rational prices, it suggests PEP's strategy of managed price increases is working. They're actually benefiting from the trade down away from more expensive specialty foods while still maintaining that brand preference over the generics.
So for all our winners, the story is the same. The consumer is acting defensively, focused on value and necessity. This creates a supportive environment for those built to capitalize on that behavior. Now let's turn to the categories that feel the pressure from this disciplined consumer. If every dollar is going toward value, that money has to come from somewhere else.
Yes, and the first and most obvious casualty is department stores and mall-based apparel.
Right.
These retailers rely on consumers feeling confident enough to spend on non-essentials. Fashion, home decor, seasonal items. Any weakness Walmart reports in its own apparel or home goods categories creates immediate concern here.
Did you walk us through why they're so much more vulnerable than a big box store?
It's their operating model. Department stores rely on rapid seasonal inventory turnover and selling merchandise at full price to hit their margins. When the consumer is cautious, they delay buying that new fall jacket.
So the inventory just sits there.
It sits longer, which forces markdowns, which instantly crushes their margins. If Walmart is confirming that people are stretching their paychecks, it implies the discretionary part of the budget has been, effectively zeroed out for many households.
The analysis points to two players here, starting with Macy's, ticker M.
Macy's is under pressure because its core business is centered exactly on those categories you can put off buying. If Walmart signals discretionary weakness, investors just anticipate reduced spending on fashion and home at Macy's. They're kind of stuck in the middle, not as value-focused as Walmart, but not a true luxury brand either.
And what about Nordstrom, JWN? They serve a more affluent customer. Shouldn't that insulate them a bit?
Not entirely. While their customer base is generally wealthier, the analysis highlights a key risk: their reliance on full-price selling. Even wealthier consumers become more selective when the economic outlook is uncertain. They might not stop spending, but they might wait for a sale.
So that hurts their model too.
It does. And Nordstrom's operation is even more leveraged to those seasonal fashion shifts. A cautious signal from Walmart just increases the risk that Nordstrom might have to aggressively mark down inventory later in the quarter, which hurts their profitability.
Okay, so the second category under pressure. Pure play discretionary and home-focused retailers. These are the specialty stores for things like electronics that boomed in prior years. Why does softness at Walmart cause so much alarm for them?
Well, if Walmart, the retailer known for being the price leader, reports weak demand in things like electronics or appliances, it strongly suggests the consumer has just paused all large-ticket discretionary spending.
If they're not buying a TV at the lowest priced venue, they're definitely not buying it somewhere else.
Exactly. It signals a pause in upgrade and replacement cycles. And this group also faces a double threat, not just weak demand, but more competition from Walmart itself.
How so?
Walmart's scale lets it be aggressive on price, even when demand is weak. If they see TVs piling up, they can run promotions to move that inventory. They can afford to take a lower margin on a TV if it means the customer also does their huge grocery shop there.
Right, it's a traffic driver for them.
And that aggressive pricing squeezes the margins for the smaller, dedicated rivals who just can't compete on that scale.
Let's look at Best Buy, ticker BBY. How does this affect them specifically?
Best Buy faces pressure from both sides. First, weakness in electronics demand means their core market is sluggish. Second, if Walmart aggressively prices key items for the holidays, it forces Best Buy to match those prices. And since Best Buy doesn't have a massive grocery business to subsidize those margins, that really hurts their profitability.
And this also impacts a general merchandise retailer like Kohl's, KSS.
Absolutely. Kohl's is vulnerable because its merchandise mix is kind of straddling apparel and home goods. If home goods demand slows, and if Walmart gets more aggressive on price for kitchenware or bedding, it creates margin pressure for Kohl's. The customer Kohl's is targeting is the exact person who is highly motivated to just buy it at Walmart while they're already there.
So they lose traffic and pricing power. Okay, this final category of losers is, as you said, a bit counterintuitive. Dollar stores and extreme discounters.
Right.
Companies like Dollar General, DJG, and Dollar Tree, DLTR. Aren't they supposed to benefit when the lower-income consumer pulls back?
That is the traditional view, but the analysis highlights a direct challenge from Walmart's superior grocery-anchored value proposition. Walmart is effectively blocking the traditional trade-down path.
So how are they doing that?
Well, think about how dollar stores usually win: proximity, convenience, and low prices on non-perishables. But Walmart is now gaining share among the most price-sensitive shoppers because of its robust grocery mix and, critically, its private label offerings.
The private label strategy sounds like the core of it.
It is. Walmart's private label food, like their Great Value brand, is designed to aggressively undercut national brands. For a consumer facing budget pressure, switching to Walmart's private label provides immediate, noticeable savings.
And the dollar stores can't compete on fresh groceries.
For the most part, no. And that's the problem. Consumers have to buy food. If Walmart can capture that grocery dollar, they often capture the entire shopping trip. The consumer doesn't need to make a second trip to Dollar General because they can get household goods at an equivalent or better value at Walmart, often using that private label option.
So Walmart is using its strength and necessities to basically starve the dollar stores of the traffic they need?
It's a traffic war, exactly. The success of Dollar General DG depends on that traffic. But as Walmart's results suggest, they're pulling that paycheck-to-paycheck customer into their stores. Dollar General faces this intense competition. It's a direct cannibalization.
And what about Dollar Tree, DLTR, with its fixed price point model?
For Dollar Tree, the impact is structural. Their model is incredibly lean. If Walmart engages in sustained aggressive price messaging or uses its private labels to price items below Dollar Tree's typical entry point, it forces Dollar Tree into a tough choice.
Either lower their own prices and kill their margins, or lose customers.
That's it. The battle for the most price-sensitive customer just intensifies, potentially harming DLTR's profitability. The convenience of the dollar store, while it's important, may not be enough to offset Walmart's grocery-anchored, scale-driven value proposition in this environment.
So in essence, the lower-income consumer is trading down, but they're trading down to Walmart and then trading down within Walmart to private labels instead of going to the dollar stores. This analysis really provides a clear picture of consumer discipline. The consumer is prioritizing value, which supports scaled retailers like Walmart, WMT, and its peer, Target, TGT.
And they're prioritizing necessities, which benefits club stores like Costco, COST, and BJ's, BJ, and the major branded suppliers like Procter & Gamble PG and PepsiCo, PEP, who can maintain that pricing power.
And on the other side, that disciplined spending creates a lot of friction for sectors dependent on desire-based spending. We see pressure on department stores like Macy's, M, and Nordstrom, JWN.
And specialized retailers like Best Buy, BBY, and Kohl's, KSS, face that double threat of weaker demand and competitive pricing from Walmart.
But the most revealing aspect, I think, is how Walmart's scale and grocery strength is squeezing the niche value players like Dollar General, DG, and Dollar Tree, DLTR, really challenging those traditional assumptions about the budget shopper.
It's a reminder of how a single company's performance can provide such comprehensive insight into where consumer dollars are actually flowing.
As we close out, a final thought for you to consider. If the lower-income consumer continues to rely more and more on Walmart's private label grocery options, which are highly profitable for Walmart, What long-term strategy does that force major branded staples companies like PG and PEP to adopt to protect their volume and their shelf space? That dynamic, that tension between supplier and retailer will define the coming quarters.
That's an excellent point. That tension is absolutely key to understanding the next competitive frontier.
Before we finish, we must emphasize that this analysis of the retail sector, including the discussion of Walmart, ticker WMT, Target, ticker TGT, Costco, ticker COST, BJ's Wholesale Club, ticker BJ, Procter& Gamble, ticker PG, PepsiCo, ticker PEP, Macy's, ticker M, Nordstrom, ticker JWN, Best Buy, ticker BBY, Kohl's, ticker KSS, Dollar General, ticker DG, and Dollar Tree, ticker DLTR, is based purely on the information provided by the author. This information is not financial advice, and we are not providing any buy or sell recommendations. This is purely the opinion of the author. Thank you for joining us for this analysis on breaking news to trading moves. We hope this knowledge aids your understanding of the market.